Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. Welcome to Charts of the Week for January 18th, 2021. Please see our disclaimer for important information. As we begin our presentation this week, we revisit an old chart that we typically show here on the front end. That's our COVID tracker from covidtracking.com. It shows in a very visual way kind of the trend line of our 7-day moving averages for both daily new positive cases for COVID-19 as well as daily deaths. And both of those are continuing to trend up. Had a little bit of a hiccup there right at the end of the year, kind of heading into the new year. But as you can see, we're beginning to trend much higher as we sit really on the cusp of all of this max vaccination. As a follow-on to the prior chart showing the uptrend in daily new positives, this is basically a reproduction slide that kind of shows you from a medical study done late last year on the transmission rate of the virus. And anything above 1 indicates a positive transmission rate. We want to see that below 1. That shows essentially a contraction in the infection rate. Right now, we're trending probably around 1.5 or so, and obviously that's a number we want to continue to track. We've had some dips in that, so the near-term trend line, as you go back to November, is certainly down, but it's still above 1. So we want to continue to see that drop. Vaccine doses are rising after a rather clunky start. Good news is that we're getting more on a daily basis, and this is data going back to December 21st when we really first began to see the rollout amongst that 1A group. So we're beginning to transition a little bit more into the 1B group. That will take a while, but I think, by all accounts, there's an increasing level of confidence by the time we hit certainly the second quarter that we'll be well into mass vaccinations, well beyond the first responders and elderly, most vulnerable folks, and people like teachers and more of the frontline exposure cohorts. It's a survey from Ipsos, which in a positive way, that big bold blue line represents the percent of respondents that would take the vaccine as soon as it's available. So if you go back to September, that number was fairly low. There was less confidence in the ability to produce a vaccine, and less confidence in really understanding what the side effects would look like when the vaccine was rolled out. Now, as it's being rolled out, and we're having some kind of anecdotal evidence that people aren't suffering by and large from any significant side effects and whatnot, you see that number continuing to rise at the expense of those that are willing to wait a few weeks or months after. And then, unfortunately, to some degree, you still have in that gray line, you still have about 19% of the respondents as of really a few days ago that said that they won't take the vaccine under any circumstances. This is the hospitalization rate that I mentioned earlier. As you can see, it's a ratio of hospitalizations, and the current trend line is down a little bit, even though aggregate bed utilization is a little bit higher. So this is ebbed and flowed, as you can see very poignantly in this chart. It peaked at November, December. And this is a nationwide number. The source on this is Bloomberg. So it's still elevated, certainly elevated to where it's been previously during this pandemic, but the trend line is down, and I think that's positive. If we can get that reproduction rate below 1, this will certainly help this particular chart continue to fall. From First Trust, we have our high frequency data tracker, and I really, outside of a few things, there's some positive trends. I'll focus on the positives here, and that's rail car traffic. We've got some data that will certainly show that trade and imports and durable goods, I mean, exceptionally strong for considering that we're still in a pandemic here. So rail car traffic is real strong. Steel production relatively strong. The month and the weekly data is really good on steel production. Even hotel occupancy is perking up a little bit here in January. Daily rates and RevPAR, revenue per room, looking good. Restaurants, a bit of noise in the data, even though the week was down, the month is up. And checkpoint data at TSA, airport travel is over the week. This is a little bit of noisy data. We had a lot of people travel here in the first week of the year that were gone for family-related travel for the holidays, and then now this is kind of a give back of that here in the second week of January. But over the last month, it's positive. So by and large, reasonable data, and I think at this point we'll take what we can get. Labor market is still a little bit mixed. As we've discussed here before, we had a little bit of backtrack in the labor data for the first time in many readings on the unemployment side, but we'll continue to monitor that. This I thought was interesting. I came across this. This is from Longview Economics and Microbon. It just shows you how different parts of the world are trending, differently in this pandemic. And in this case, it just happens to be seated restaurant diners, U.S. versus Australia. The red being Australia here, and the black being the U.S. And as we've had more imposed re-lockdowns, if you will, or capacity restrictions going from like 75% to 50%, or maybe even some cases interior dining being shut down. You can see that restaurant diners in the U.S., that continues to roll over from, I'd say, clearly an interim peak there right at in September, but more of a recent peak there in October. And that number in the U.S. continues to trend down, whereas in Australia, number goes up. It just shows you the uneven nature of the how the pandemic is progressing around the world. All right, now we transition a little bit more into some economic data. As we look at the black line here, this is the trade weighted dollar. This is essentially the US dollar mapped against the price index for imports. So this is something that we want to track because it's important to overall inflation. The idea is that, as this dollar has been weak, and we've been talking about this for some time, that you run the risk of imported inflation. You just think about this: if your currency is weak, and so the foreign currencies are stronger, so what you're doing is you're paying more for imported goods, which is essentially an inflation on imports. And as you can see, this data here from the Federal Reserve Bank of St. Louis, from their FRED database, that that's clearly playing out right now. Again, and I think it has a more subtle influence on overall inflation. We know that net trade is maybe 10 to 15% of the total economy. So it has some influence, but right here you can clearly see a weak dollar is equaling higher import prices by virtue of the numbers reflected in this index here. And this is a dollar trend. This is from Deutsche Bank, Bloomberg Finance, kind of a collective study here, and it's just different time periods. And I guess my takeaway in reading through this was kind of interesting. It just says that the dollar trend coming out of recessions, and obviously we had one last year, albeit a brief one, that the trend line, if you look at days, if you look at a timeline, that typically you have weakness in the dollar. And so I just I kind of highlight this to show that this kind of reinforces my thoughts that we're going to have a lower dollar for a while. It will help exports. It might contribute, as we saw in the last slide, to imported inflation. It may curb imports to some degree, which would help our trade deficit. But in any case, I think a weaker dollar is probably here for the time being. And I would surmise too that I think that we've got a little bit of weakness left to go on the dollar before it re-strengthens. Here's our inflation barometer. This is from the Bureau of Economic Analysis and the Federal Reserve Bank of San Francisco, as a matter of fact. And these, I think what's important here is the forecast. And this essentially comes from, government sources and the Fed sources, and this is their own internal staff projection. So what it tells you, again, 2% is that magic number that we've been talking about. The Fed's target has evolved, and as of last summer, they said, listen, we're not going to try to target this all the time, but we're going to target 2% over a period of time. And for us to see higher interest rates, for the Fed to feel like it needs to move short-term interest rates higher, we're going to have to see above 2% inflation for some time, to where this overall inflation averages 2% over a period of time. As you can see here, you can go out to 2024, and it's not going to get there. We may have a snapback in 2021. I do think we're going to have more inflation this year. We've talked about that consistently, as well as my outlook. But I think a sustainably higher inflation, which continues to trend higher, I think is a little bit of time away from us, though. And this is a kind of a corresponding chart here on interest rates. Obviously, there's a positive relationship between inflation and interest rates. This is interesting in the sense it gives you different kinds of interest rates. It kind of shows you the yield curve on one page right here. So obviously the dark blue represents the federal funds rate, which was basically close to zero for many years, and then we started ratcheting up the short-term rates consistently until we got to 2019, and then obviously in the wake of the pandemic, those have dropped back down to zero. The two-year Treasury yield kind of follows along. We had some steepening in the curve in 2014, 2015, 2016. That's now gone away. We've got a pretty flat curve on the short end. So short-term two-year Treasury yields are really low right now. And as you get into the 10-year yield, this is what I want to focus on in this slide, is you typically see 10-year yields that are at least the inflation rate, an inflation rate higher than short-term rates, because it's meant to show what the term premium would be on longer-term interest rates if you have inflation. The required rate on 10-year treasuries would obviously be influenced by what you think inflation is going to be. Now, having said that, if you look at 2020 and 2021, you can see that red line trending back up, and that's indicative of inflation expectations beginning to perk up. Now, what that means is that the yield curve is steepening. This has implications for a lot of different areas. Obviously, this is good for banks, good for financial institutions that are lending on a spread. This is a little bit better for savers, and your expected returns on longer dated fixed income are going up a little bit. So there are some implications here, obviously, for mortgage borrowers where the 30-year fixed mortgage rate is benchmarked to the 10-year yield. You can expect probably those rates to move a little bit higher. But clearly, the last point on this slide is that you've got a long time to go before you get back to prior spreads of that 10-year to 2-year interest rate. This is a chart of low wage workers versus high wage workers. I just want to just highlight that. I thought this was interesting because you've got low wage workers that are clearly much more impacted from an employment standpoint than high wage. I think this is all very intuitive, but I thought it was very interesting to kind of show those brackets broken out. And there's a very clear socioeconomic impact of COVID-19. Renters' confidence. We've talked about the issues related to the rental residential market, and this is renters' confidence in being able to pay their rent. And you can see as we head towards the end of the year, the no or only slightly confident respondents are increasing, and that blue line down below, that the thought or the fear of eviction is going up as well. This is a chart of monthly U.S. household post-tax cash income from Longview Economics and Macrobon. And you can see the impact of stimulus there in the wake of the pandemic and the $2,000 checks that went out, and then that stimulus waned. And so at a point where at the end of this year, we had that back at trend line, as you kind of show that line of growth, that's kind of that straight line of best fit. If you look back over several years, and we kind of got back to that trend line. Now we're going to have another boost. We've already had it, essentially, with the $600 check. So we know incomes are going to go up by virtue of that, but we do expect that to roll back over here in the coming months. Weekly Consumer Comfort Index, and this has an influence from a lot of different things. I think that there's an influence on this because of the acrimony surrounding the post-election environment and the Capitol riots and things like that. It has some other things involved in it as well. U.S. Personal Finance Index is down as well. Obviously, this is something that we should be careful with and we should be concerned about. We certainly don't want to see these levels continue to drop. The consumer is very vital to this recovery, and they've been very instrumental in helping to support this better than expected growth in the economy in the wake of the pandemic. But we definitely need to see these numbers settle out, and we'll continue to monitor these. Household bank deposit growth. This is something that that I found that I thought was really interesting. And again, we know that the savings rate has gone up. It typically does in a recession. Certainly did this time. A lot of unusual one-time stimulus type payments that we found that people at the higher income levels were actually just putting in the bank, or they were paying down debt, so they were improving their balance sheet, whereas people at the lower socioeconomic levels were actually spending it in the economy and contributing to consumption and whatnot. But here you can see, if you look at overall bank deposit growth year over year, we're at a really high level, and a level that we have not seen in a long time, in terms of year over year growth. Appliances. This is our statement on durable goods. So this is U.S. seaborne imports of home appliances from Panjiva, and it just looks over a multi-year period. Let's call it 5 years, if you will. And so you can see the really strong response in a lot of different categories, whether it's ovens, refrigerators, and a really strong response. So this durable goods has been a really bright spot overall in our economy, and it's really borne itself out in not only the high frequency data, but also in some of the shipments data. And looking at container volume, we're actually up year over year for the data that is available to us right now. We've got, this is essentially inbound container shipments at the Port of LA and Long Beach, which is still in the top, I'd say the top 12 to 15 ports in the world. Obviously, China has a lot of those ports in the top 5, but LA Long Beach is probably the largest port of entry for goods here in the U.S. And in some respects, it's positive to see this number be above a year ago. This just, again, it speaks to the issue of more consumption, more durable goods activity, which is good for manufacturing. We've seen good manufacturing data, and despite the weak dollar, We've seen fairly strong import volume, so this is obviously reflective of that, and it's a clear signal of health amidst some other mixed data with regard to the economy. Durable goods shipments. This is just putting into pictures what I've been telling you for the last 5 minutes or so. That number in that red circle represents a positive trend. This is from CAS Information Systems, and again, really positive data to see durable goods shipments look, be above the break line there. A couple of commodity check-ins here. The commodity basket, we know commodities have been very strong. Commodities tend to be stronger when you have a weak dollar. That is certainly the case with corn. You can clearly see here the near-term contract of corn really looking strong on a per bushel basis. Sugar continuing to show strength heading into 2021. A quick check-in here on emerging markets, and I've been advocating, this is part of my comments in the annual outlook for 2021, that emerging markets were going to get more interest. And I think not as much has been written on EMs, but I can tell you, and this chart bears this out a bit, that we're looking at a fairly strong recovery in emerging market economies. I think, again, a weak dollar does help emerging markets in several different ways. Helps to make them, perhaps a little bit more competitive. And you can see here the expectations are for a nice rebound. And this is one of the reasons why we advocate for a little bit higher allocation into emerging markets here on the both the equity and the fixed income side. And a few kind of equity related things here. I don't think there's any surprise that, and you've heard me say that, that I do feel like there's a little bit of froth in the market. You can see here, there's two indicators. One, the composite index year over year for the NASDAQ at the bottom is clearly elevated. And then you look at the SIBO put call ratio. It's a lot of jargon implicit in that, but it's essentially the lower the number, the more confident and exuberant the average investor is. And these are people that are writing option contracts. And so what's clear in this is they're writing far fewer contracts that are betting on the downside than they are writing contracts that are betting on the upside. And that's why this indicator is rolled over quite a bit, and that's showing extreme exuberance, the likes of which we haven't seen in this indicator since the tech bubble. Premium of growth companies, we've been talking about this dichotomy of growth versus value. This is clearly not just a US phenomenon, it's worldwide. I do think that this is going to reverse somewhat as cyclical companies begin to show some strength here in 2021, and this will roll over somewhat more than likely. But just to show you that the growth has so completely dominated value over the last several years on a global basis, it's actually pretty interesting. Another sign of froth, if you will, from variant perception. It just shows you by sector, if you can kind of tilt your head and read along the x-axis there, that the majority of sectors in the S&P 500 are trading above their 200-day moving average. Now it's a sign of relative strength across all sectors. We do like to see it, but to see so much of the index be well above its long-term trend lines. Again, this wouldn't surprise me if this was the 50-day moving average, which is a shorter horizon, but to see this on the 200-day shows a very consistent and very strong updraft in equities. And again, I honestly think that equities have some upside here in 2021, even from current levels. But it's really going to have to depend on earnings as opposed to valuations expanding, because I really think that's going to be challenging. And when inflation picks up and as interest rates move a little bit higher, that's going to take some of the tailwind out of the equity market, and equities are really going to have to depend on profitabilities and earnings to drive continued growth. And speaking of earnings, this is why I do think that there is upside ability for stocks to move here in 2021. So the blue represents actuals. These are quarterly earnings for the S&P 500. The green kind of checkered bars represents forecasts. Again, this is from the daily shot, and it's a kind of a compilation from FactSet, I believe, and I should have put that attribution down here. But anyway, you can see here that with this sharp downdraft because of the pandemic and the uptick that we saw in third quarter, where we are on the cusp this week actually getting those fourth quarter reports from S&P 500 companies. So we'll see what happens in the fourth quarter. We're expecting them to be, down a little bit, but then really perking up next year. And so if this plays out like this shows here, again, I would, put a few cents of emphasis on what analysts say. But I think what we've clearly seen over the last probably decade is that analyst estimates have been shown to be consistently below where actuals are coming in at. So, and you can see that in that red dotted bar that is consistently laid above those blue bars. And those blue bars are the estimates, and the red dotted lines are where the actual numbers came in. So, it's possible that that we could have that red line continue to trend higher than those green checkered lines, bars here in the coming months and quarters. This is our option adjusted spread. We got a couple of charts here on fixed income. This is, essentially the spread of higher yielding, lower credit quality fixed income over the benchmark treasuries. And this is for investment grade fixed income. And you can see, we've talked about this before, but spreads are really, really tight. This chart itself tells you one thing, that the bond market is not overly concerned at all with the risk of a follow-on recession, with economic stress in the market, where there would be the risk of default, et cetera. We've seen lower default numbers than we thought we were going to see, and we think that number is beginning to go down even from where it was. We may see more defaults, but clearly, if you look at the spreads, the risk associated or that's being attributed to these higher yielding and perhaps lower credit quality issues, it's certainly not indicative of any kind of, it's not suggesting any kind of a downturn. And I usually give more forecasting credence to the fixed income market than I do to equities. And by that I mean that the fixed income market typically does a better job of forecasting inflection points than the equity market does. This is a chart on non-financial corporate debt, and this is a U.S. data. This is, and the green bar actually represents debt to GDP. So we've had a lot of companies this past year issue a lot of debt, and a lot of this debt has been higher yielding because it's been lower credit quality. But people, companies have been getting the paper floated, getting their issues floated. And the blue dotted line is the default rate. So the default rate has perked up. We knew it would. The last slide I mentioned that it really hasn't gone up nearly as much as we thought it would. And there's a lot of confidence out there basically that we're not going to see this big default wave, and it might tick a little bit higher, but I think I think on the cusp of having that flatten out and maybe even start to go down, which would be really good for the economy. I think send a really good signal through the capital markets. And the one thing on fixed income that does give me some cause for concern is that, I do think we're on the cusp of some higher inflation, which will move interest rates higher. And, just a simple rule for the average investor is that when interest rates go up, prices go down. It's an inverse relationship. So, and you want to minimize your risk of prices going down on the fixed income part of your portfolio when interest rates move higher. And so this is showing you in this yield to duration range is essentially that there's a fair amount of price risk in the market. The benchmark aggregate index has a duration of over 6 right now, and it just tells me that there's a fair amount of price risk in the fixed income market, and so that's why we have maintained a very, very short duration or low duration portfolio. We'd rather rise as interest rates rise as opposed to try to grab a whole lot of yield right now and then be subjected to having that offset by prices going down. And here is a quick chart from Pew Research on cryptocurrency. We know Bitcoin has gone absolutely nuts, and it's almost kind of an awkward-looking chart amidst the backdrop of everything else, but because of the meteoric rise in Bitcoin. But if you go from 2020 to 2021, these numbers have changed a little bit, but I think the takeaway for me is that it is still really, really hard to know what cryptocurrencies are. And the regulators don't even know. And it really is a little bit of the Wild West out there in terms of how it's being viewed. The IRS is not sure if it's an asset. It thinks it's an asset because it wants to tax it. They want to tax the gains, but is it a commodity? Is it a currency? Is it a security? And a lot of confusion on this. So, from where would you fund an allocation to crypto in a client portfolio? And this just tells you that even asset managers don't know how to classify it because it's not an alternative per se, although the majority would put it there. But some actually view it as an equity, some view it as a commodity. So anyway, a lot of confusion out there still. This is something that kind of hits near and dear to me as we kind of maybe close out today. But I get a lot of calls on my cell phone from numbers that I don't recognize that aren't in my address book, and I'll admit I'm of that opinion of letting them go to voicemail if I don't recognize them. And it's funny, from Pew Research Center, they said 19% of people that get those kinds of calls just pick up and answer. And I don't necessarily find myself in that bucket, but I'm in that probably that 67% or 2/3 majority there that will let it go to voicemail. So I thought this is interesting. It doesn't have any implications or any ramifications on stocks or bonds or anything else, but I thought it was interesting. And I don't know where y'all fit in on that, but probably I guess that many of you fit in that blue section there of the 67%. Interestingly enough, 14% will even ignore the voicemail that comes from the call from the unknown number, which is definitely not me. I'll always listen to voicemails, but anyway, interesting nonetheless. This is a 21st century issue right here. That will do it for charts of the week for this week. Appreciate you spending the time to watch this and hopefully learn something from it. And our contact information you see below, please feel free to reach out, send us comments or questions. We'd love to hear from you. Have a wonderful week, and we will talk to you again soon.